Good morning, and thank you for joining us for today's webinar, Winning in Healthcare, 5 Tips to Landing Deals and Increasing Operating Profits. This webinar is presented to you in partnership with DT Spade Specialized Real Estate and Broadwell Group, Inc. You can use the question and answer feature at the bottom of your GoToWebinar toolbar to ask questions. The questions will be monitored and the presenters will answer as many as possible at the end of today's presentation. The webinar is being recorded and it will be posted on ACG's website along with the slides from today's presentation. Thank you all again for joining us. Now I'm going to turn it over to Bryant Cornett, President and Founder of DT Spade Specialized Real Estate, and Will Melson, President and CEO of Broadwell Group, Inc.
Thanks, Cassie. I'm Bryant Cornett. I'm the president of DT Spade. I've got Will Melson with me. He is the founding partner, president of BGI. Will and I first met about 7 years ago. I was representing the tenant hospitals in this market in Atlanta, and they were going through a process to sell those hospitals. And after that, that was a very up and down, all over the place deal. And after it was over, I asked my client, the CFO of the region, was there somebody that was always in the room, someone that was part of the team that was working to purchase that hospital, essentially like the Kaiser Sose of the healthcare space? And he said, I know exactly the guy. That was Will. We were trying to put together a panel called the Deal Maker and the Regulator, and that was the beginning.
That was where we met. And what I liked about meeting you was your firm is as deep in healthcare as you guys are in real estate. And there's what, 400 brokers in the country. A lot of them have the SIO or designation, but I think you're the only one that has the FACHE.
That's right. I'm the only fellow in the American College.
Just shows a dedication to healthcare, and I think that's important because the healthcare industry is different. But the coolest thing was when you showed me that software that you have, where you can take all these data layers and less than 10 minutes, you can get everybody in the room up to speed, something that we have been doing manually that would take weeks. And then we would print these hard copy posters up, and then you've got a dynamic software. It's the coolest thing I've ever seen.
And we're going to jump into some of that right away. Before we get started, I just want to make sure that you stay with us, because at the end, we're going to talk about 3 kind of opportunities that we have to continue the conversation. The first is we've got an event on September 5th. We're doing it in conjunction with SunTrust, their investment bank, Robinson Humphrey, the Wethington Law Firm, which represents a lot of providers in the market. These are big firms in litigation issues. And then Waystar, which is one of the premier revenue cycle management software groups. But we're going to get private equity, people that are owners and prospective owners of these provider companies, and providers. So the physicians. We've got a suite anyway, so we'll talk about that some more at the end. We've also going to show you some of the data that Will was just talking about, and if you want access to that to kind of poke around on your own, we can give you 30 days in behind the firewall, password protected, to kind of take a look at some of that. And then Will's also offered that he's put together a white paper, essentially process-driven due diligence for healthcare organizations. He's got some early notes together that he can share with you, and then you'll get first look at that. So if we jump in, we promised 5 tips to win healthcare deals. Will and I have both been on the client side, on the provider side. That's what we call healthcare organizations, when they're going through a process. And one of the first things that we see is, does the group have a culture to win? And what does it really take to win that deal? So while we talk about that for just a minute, we're going to jump straight into a poll. There we go. So if the folks on the phone can, or on the line can answer this, we'll talk about this a little bit. But
yeah, so what we want to share with you is what nobody would really tell you after you leave the room, and the discussions are going on with the various targets, your target acquisitions. Obviously, we're going to think of some of these automatically. Traditionally, you may think, well, anyone in healthcare is interested in maybe one or the other, but it'll be interesting to see what the audience thinks is the most important.
Yeah, so I'm going to go ahead and close it out. You gotta act quick around here, and I'll share the results with you. It seems like that independence is the thing that most of our folks feel like is the the decider?
Well, that's pretty well known, Bryant, that physicians want to maintain some amount of independence. I think you can work around that in terms of clinical independence versus administrative and management independence. But the one thing that does seem to get maybe the most overlooked, although I see 23% of our respondents, is the fit and the culture.
Yeah.
And that is physicians and healthcare groups are getting smarter about selecting PE partners that not only give them a good price and let them maintain independence, but that they feel like are going to be a good cultural fit partner for them strategically in the long run.
Yeah, and I had a little story to share about that. I was at a really well-respected healthcare kind of innovation conference. So a lot of bankers, technology folks there, people with different technology solutions, and the aesthetic, just the tone, the everything, there was just a different feel in that than there was at, say, an American College of Healthcare Executives or an ADA meeting.
Right, right. Well, and I think one of the things is when you're looking at growth and working together, you want to make sure that it's someone that you want to be in that boardroom with for a long time, and you want someone that you can trust. And so that really accelerates growth, because a lot of PE firms are going to be selling growth as a way to benefit financially.
Right. All right. The second thing that we wanted to talk about is exits that are not on the map. Are there things that you might not think about that aren't just sort of the A, B, C, D that can really add value to practices? And we're starting with, can you get paid to get bigger? I know in dentistry you can buy 5 $1 million practices, and all of a sudden they're worth 8 together. Right. And you can do that 10 times and it's worth 100, not 80.
Well, that's because in a provider network, patient access is so important. And all of a sudden, people who want to be able to have seamless health care, whether it's where they work or where they reside, or even when they're on a vacation close to home, a staycation, that access to health care really can increase the multiples.
Well, and I've also seen, I know everybody knows that when you go from that 1 to 5 or that 5 to 50, there are some efficiencies. You can have centralized booking, costs, and scheduling, but there are specializations where you change nothing and just being bigger gets you into it.
Just being bigger, that's right, because there's so much risk associated with being small. There's safety in numbers. There's been books written about that, and being bigger does reduce risk, and so therefore your discount rate and your DCF should be a better discount rate.
Yeah. Okay, so this is one that I think is that I definitely wanted to share. There is an arbitrage between EBITDA valuation and cap rate. Essentially, cap rates is an inverse multiple that we use in real estate, and so I'm going to show you kind of a quick example here. We've got a $2 million EBITDA practice that's paying $275,000 a year in rent. Check. There's a 6 times practice multiple, which is sort of middling to good, and a 6 3/4 cap rate, which means that an investor buying a piece of real estate that's well leased with a physician group would accept a 6 3/4% return on NOI. That gives us a practice value of $12 million. We've got no building value because they're just leasing, and so we have a total enterprise value of $12 million. All right, could we juice that by 18%? Well, here's how you do it. You take the same scenario, except in this case we have purchased a building. We're going to call it a $3 million building, and we'll show that as it comes in. We don't change the market by this. This is just us making different decisions. Practice is still worth $12 million, but we've got a $4 million building. And so when you net out the $3 million that you paid to sort of get there, you've now got an 8% bump on your total enterprise value. Can you juice that? And the answer is yes, to an extent. So at some point you break the picture and you no longer have a real estate deal in a practice. But could the practice afford to pay another $125,000 in rent? Yes. And could we? And does that affect EBITDA? Yes. Again, we wouldn't change the market, but from a practice value standpoint, we've lost $750,000 in value. But from a building perspective, no change. It's the same $3 million building, but it's now worth $6 million when we take it to market. And so that gives us a significant bump.
That is significant.
this is scalable. It doesn't always work, but it often works for a group that's patient and willing to do. And I think it's also one of those exits that just maybe haven't thought of.
So you can kind of help figure out where that sweet spot is of.
Well, it's the arbitrage. And could it work the other way? If we got into a high value, high multiple practice, could we back out some rent in something that we own to juice the EBITDA? And the answer is yes. Community needs analysis.
This is something that really, as soon as you close a healthcare deal, you need to have a community needs analysis, because what this does is it takes into account the incident rates and the number of physicians, competition in the area. It tells you precisely by specialty, by geography, where the community is going to need more healthcare. And so combine that then with the maps that you have, tells you where the big picture of how you need, which specialties to put in, and where precisely is the best place to put them, so that you're matching that with the consumer spend. Combine that with a financial analysis, tells you the impact on your EBITDA. So it's kind of the secret weapon for the smart firms once they acquire a healthcare company.
And having done this shows up as a little bit of a three-dimensional data set, because you've got on one axis, you've got the different subspecialties and specialties, and sometimes even down to the procedure level.
Sure.
But let's stick with specialty. And then on the other axis, you've got locations. And so we're looking at competition, we're looking at market size, we're looking at how many of those procedures would and specialists could we do. But then the third dimension becomes when you start to connect two of those, sometimes they drive each other and really begin to create a bigger pie.
Absolutely. So, if you have a population that's maybe going to have experience more diabetes, you're going to have multiple specialties that's going to feed that. Not just necessarily the ones that you automatically think, but once you get into healthcare, you start understanding how one specialty feeds another.
That's right. All right, moving on. Our third point is know when the money is made. And I think we've got a poll for this one. Is that right?
I think so. Okay, so where do you make money in a deal?
So if our participants will fill this poll out.
Right, you got several choices there from beginning to end. Obviously, you want to maximize return on net capital. So if you're putting, if you're writing a check for $2 million, a lot of times it's measured by at the end how much you get. There's a lot of green grass, as we might say in golf, between that first purchase price, the due diligence, and the disposition.
Yeah, that's right.
So it looks like a lot of people are responding. Maybe we leave it open for a few more seconds. Everyone want to vote?
Yeah, I think you got to move it. All right, sharing the results. Post-merger integration wins.
Wow, I'm impressed.
We got a really, really well thought out group.
Right, because private equity is traditionally good at the first two, and the last one, no doubt about it. It's where you make your money. Let's talk about where you can make some money on these, especially since 47% of the respondents chose post-merger integration. Interesting that not too many chose run it better than the seller. So here's one particular case study. It was 52 operating companies over a 4-year period, spent a lot of effort into integrating and improving the operations. At the end of that 4-year period, they had seen a 177% increase in share price, not too shabby. But the thing that really stands out in this particular case study is they weren't just holding on to the cash. Dividends increased 64%. Of course, earnings had a lot to do with that, running the place better, 63% earnings. And what this particular company did was they had a roadmap built for every one of their operating companies and to figure out, should we integrate them and assimilate them into larger super subsidiaries, or leave them standalone and just treat them like a bank.
Yeah.
And so there's a different decision on every one based on the region, the market, the competition, the products, everything that's there. And then one particular subsidiary actually grew from 300 million to 5 billion during this period of time, mostly through acquisitions. But then you have the same process that has to be done with those. Do you combine those operating companies add-on style? Sometimes the answer is yes. Other times, maybe based on just the leadership in a particular market, you're better off leaving them standalone and let them remain as competitors, even though from a parent standpoint, you own them both.
Right.
Another case study, this one, you can make money or lose money in the integration. So 47% said make money in the integration. You could actually lose some. Here's a actual case where 2 companies were divested from the same group. So this group was divesting. So the exact same supply chain, the exact same IT systems, everything the same. One operating company number 1 hires a firm, and they had between 5 and 22 people at any one time. So an average of 12 consultants working on this integration. Operating company 2 hired a different firm. They put a larger team in place, 95 people on average. It was up to 121 pounds. The smaller team took about 8.5 months to complete the integration, and the second team was a little over 24 months. So if you just add up the cost of that, that first operating company would have spent about $8.5 million. It was. The second operating company, a lot more money. You've almost spent everything that you would have made.
Yeah.
Not only that, the operating company number 1, because they got their integration done in 8.5 months, well, they've achieved their business case, and so
They get to start the race.
they get to start the race. They're starting to see their EBITDA.
Yeah. And I think especially just culture-wise within healthcare organizations, even if you have a professional leadership class, there's probably a strong pull to let's put more people on it for longer, because that's been the answer for a long time.
That's been the answer for a long time. The third one is something that would probably resonate with folks out here, is putting together a lot of fragmented resources. So this particular one was 60+ imaging centers. Some people say, well, you know, would you use an average down strategy? No, in this particular case, the decision was we're not going to do an average down strategy, but we're going to keep key resources in place, but then focus on top line growth. So there was investment in the facilities and the equipment. So 1.5 Teslas and 3 Tesla machines. That led to more referrals. And then of course, more referrals means more top line growth money, and eventually better leverage with the payers.
And so I guess just wrapping up on this point, kind of where in early on is the money made? Yes, post-merger integration, but there's really just kind of a holistic process that has to get wrapped around, because I mean, we're probably preaching to the choir, but there's never one arrow that it's not easy.
You should be making money in all 5 of those categories.
Right. And really tamping down.
Right.
Mm-hmm. All right. Point number 4, do you know what to count? And first of all, we're talking about, do you know what you have? And so in some of that early due diligence stuff, we have seen used a really interesting technology solution. Think about a Pennsylvania group is buying a 50-unit physician practice that's spread all over the Midwest. Well, who actually is going to lay eyes on those? You know, and is it the right person? And I think we've gotten used to, okay, we can't quite do that. So let's just send somebody low enough that we can afford for them to spend a week or 2, you know, touring and just laying eyes on all these locations. We have seen a solution that's used a lot in residential, but that actually goes in and can create an electronic digital walkthrough of all of those offices. So it would be possible for you and the entire executive team to see all of those offices in an afternoon from your office without ever getting on a plane. And then to be able to tell the money, I and my executive team have seen all of these offices. I think also you would be shocked at the public companies that are tracking their leases on an Excel spreadsheet.
I don't know if it shocked me, but it should shock.
Probably would. Right. But the fact is, those are very complex agreements. They need a system. If you get past 8 locations, you really do need a system that's going to help you live. We call it living 24 months out. You know, do we know what's coming up? Do we know where all the kind of intersections are and opportunities that we have to move and grow the business? The second thing is this idea of the retailization of healthcare. And I'm going to just pop over really quickly and show you a little bit of a case study that we did. This was a group that we have that's out of South Florida. They are actually a healthcare service organization. So they acquire a lot of these practices, but then they're also bringing them into their offices to train. And we talked about, can you get paid for getting bigger? Some of the groups that are winning right now are the ones that have found a way to keep the physicians involved and give them a piece of that getting paid for getting bigger. And this is an example of one. But when they look at what's our target market, it's not a drive time for them. It is every direct flight, airport, in, and then a 30-minute drive time around. And so you're looking at a macro level. This is county level data. This is dental spending density throughout the country. So yes, it's a measure of density, but it's a measure of consumer-driven density of spend. You then look at the direct flights that are shown in all these beautiful colors, and we've taken each of those 30-minute drive times, and we've counted how many dental offices are in there and what's the total sales volume of all of those dental offices.
So you're drilling in on this live?
That's right. Aggregate all of that, and you've got 11,800 dentists that live within a 30-minute drive time of a direct flight from their location, and that represents a possibility of $12 billion in revenue. So as we're looking at, are we in the right location? Do we have enough market catchment? For them, market catchment is much different than for a typical physician group or other. I've got one other thing here. So once you get in market, county data is kind of trash, and we're surprised how many people are trying to run healthcare organizations on zip code data, which is the worst. And so this is actually a healthcare spend density map. I'm going to zoom. You asked if this is live. Yeah. Let me just zoom in a couple of ticks. But you're looking at the same, well, that's too much. You're looking at the same healthcare spend density, but on a census tract level. And so much, much easier to understand kind of where is there a density of population, but more importantly, a density of spend. Because I think as a people, we've gotten okay with, there's people there. Well, are they buying what you are selling, or is it just people?
That's one of the things I really like about the software that you did, because it's funny, you talk about zip codes. We use sub-zip codes in our manual effort because that's all the time you have.
Right.
This is powerful.
So we lay over that consumer piece, the actual physician practices within the market. This is every physician practice within the Atlanta market. We've built this out for most of the country, but the size of the circle is based on the revenue of those physician practices. And then for this particular model, we were looking at, it was an orthopedic group. So we're showing now competition laid in. So we have a consumer piece, we have a competition piece, and then we have a kind of a middle ground consumer piece with the physicians. I'm going to take that physician data off. I'm going to wash that out, and I'm going to show that as a heat map. So now you're seeing where households are spending money. That's the throw. We're now showing where individual physician offices are catching it, and then we've got an idea of competition too.
That's cool.
And so what have we spent? 6 minutes, and now I think that the entire group, the 50 or 100 people that are on this webinar could have a conversation about the opportunities within orthopedics and the risks in the greater Atlanta market. So it brings everybody up to speed quickly.
You can do this in any market in the U.S.?
Yeah. But I think the thing that we really want to open people up to is that you can count things that you never dreamed you could count, and we can measure things, and we can give you kind of an idea on, hey, this sort of 15 practice group that you're buying, they should be performing a lot better, because based on your portfolio, all of these offices are in better locations, but the numbers are down. That's value.
That's value.
Low-hanging fruit.
We have a poll for this one?
I think so.
Okay.
Let me, if you bought a healthcare organization, where is your lowest hanging fruit?
So this is an interesting poll because there's opportunity in healthcare. It's everywhere.
Yeah.
There are some things that you would think of automatically based on maybe the most recent deal that you did, or maybe based on where you're training, if you came from more of a quantitative background, or even sometimes the founder of your PE firm.
Yeah.
They may have a certain bias where to go first.
Well, and I don't want to steal your thunder, because we've had a lot of conversations leading up to this, but you had a really incredible statistic about the processing costs in healthcare.
Yeah, Kevin Schulman, who's the leader of the Stanford healthcare think tank, did a study actually while he was at Duke, and the transaction costs in healthcare are 27%. That, compare that to if you use a credit card, a Visa transaction cost is what, 3%?
Yeah.
Amex is what, 4%? And so there's a lot of transaction costs. That means just processing things, not doing something for a patient, but the processing. And a lot of that's tied up.
We got our results. Operating expense normalization.
Okay, so operating expense normalization probably is where most people are going to get the money the fastest. If you look at billing departments are historically over normalized, and so if you have an acquisition that's spending 8 to 12% in their billing department, that could be cut in half. They're historically inefficient. They don't use technology. A lot of times they'll have technology that they've already purchased and they're not using it. Physician and staff compensation didn't get a lot of, only got 5%. Payer contracts, definitely.
But wait, why do you think that is? A
lot of times I think the assumption is that you're not going to change physician compensation. That's not actually always true anymore. Especially the physicians who are coming out of med school. It's almost two groups of physicians. You've got changing of physicians, their ownership is going down. They are starting to sell their practices to say, just let me be a doctor. And so maybe they were compensated prior for their administrative duties and for those management duties that they don't want to do anymore. And so what you have to do is you have to normalize that to a specific region. So, if you're in the Midwest or if you're in New York, there's going to be an average compensation for the physicians. Payer contracts, as you get bigger, you're going to have more leverage with payer contracts. So certainly you would hope that most everyone's, when they're making acquisitions, are taking a look at that. IT costs, though, I'm surprised it's down so low. Maybe it's because we call it the low-hanging fruit. But believe it or not, we had one case where the client had 196 different IT systems that they were paying maintenance fees for. They had those licenses. They had IT department to have to support all of those IT systems.
Like a hoarder?
Yeah.
Like an IT hoarder.
Right. So, it wasn't really that, it was low-hanging fruit to cut that just in half and say, let's reduce this, let's standardize it. People loved it because then they didn't have to have all the knowledge of every single one of the systems. Productivity, though, I think is really high in healthcare. The reason it is because our workflows just haven't been studied. As you said earlier, Bryant, a lot of times the solution is just put more people on it. Or a doctor may say, I want more nurses, or I want more staff, or I want more people at the reception desk. And so increasing productivity is something that we spend a lot of time doing.
Nice. All right. I should have mentioned this before, but we are opening to questions. In fact, I think next. So we've got a couple of questions kind of teed up, I think, already. But in the chat box, you can ask a question and we will we'll answer it. It looks like our first question is, does geography affect multiples?
Yes, actually, geography does affect multiples. If you think about a practice in New York City or in any large metropolitan area where you're going to have competition, and but at the same time, you also have more ready supply of substitutes. You have ready supply of staffing versus, say, a practice that's maybe in a mid-sized market. So it's maybe not the geography itself, but that practice in a mid-sized market may be dominating, and they may have excellent quality scores, community support. And so you would evaluate the risk of maybe that practice in a mid-sized market as lower risk and therefore deserving of a better discount rate.
Better chance to dominate that market. I mean, we've got a couple of physician groups here who pretty much set rates for the market.
That's right. Even a market the size of Atlanta. So you have to
get
really
big enough.
Really have to just look at the fundamentals. So in a way, geography affects it, but you're still looking at the fundamentals of competition, costs, the supply chain, the staffing, and the risk associated with all those.
I think staffing is a big risk when you get the more rural you get.
It is, and we've solved some of that through staffing agencies. Of course, companies like MDA, it's based in Atlanta, or
Apollo?
Apollo is based in Atlanta. Apollo's a great company. So, we've solved it for certain specialties, like those are primarily in the ED department areas. Anesthesiologists, you're seeing that. Some specialties are going national, like gastroenterology, for example. So there's the ability to sign these contracts for 12 months or 24 months for a short-term contract to have a physician placed at a location. But nurses, on the other hand, nurses are still pretty much relocate them permanently. And so there's still a real shortage, especially for some of the nursing specialties like nurse anesthetists, which are just a shortage of them nationwide, no matter where you are.
Let's see, I think we've got some other questions here. Okay, what specialties in healthcare offer the best opportunity for a roll-up now? And they've given a couple of examples: dentistry, dermatology.
Well, so this is an interesting question because you have two directions happening right now. So gastroenterology is one that's getting rolled up nationally. Imaging is, I think, is an area. So basically those ancillary areas are the ones that you're going to see rolled up first. But at the same time, what people are realizing is the benefit of having a micro ecosystem that is self-supporting with its referrals. And so what you're seeing is geographically, maybe not by specialty, but geographically rolling up so that you have primary care feeding the specialties all the way through oncology and infusion and the surgery centers.
Yeah, but I mean, that's like a super roll up.
That's a super roll up. That's right. What you're going to have
trying
happen.
to control the whole value chain in healthcare is
that's a big deal. You have some, actually about 25% as of 2018, about 25% of practices today are these multi-specialty practices. About 50% are what you would say are single specialties. And then you have the rest that are made up of either a faculty specialty or physicians are working for a hospital or a specialty that's maybe just a neuro and a cardio together.
Well, and the dental, there is obviously a huge infrastructure for that.
Right.
I think that Equity likes it because of the low acuity. It's rare someone dies in a dental chair.
Right.
I think also, for me, what I've heard is the standard of is the practice worth something? It's if you went there and another doctor walked in, would you leave? And I think OB and gynecologists, they a lot of times will pack up their stuff.
Right.
Unless there's been sort of but for that reason, I don't see a lot of. In fact, we've had older doctors who have said, my practice isn't worth anything. I'm shutting down.
Right. Right. And you see that, I mean, I think what we say is the closer you are to a consumer, no matter what industry it is, the closer you are to a consumer, the more protection you have. And the same is true in these specialties. So, anesthesiologists, how many patients even know who their anesthesiologist was, ever even know the person's name? On the other hand, primary care holds a big loyalty and certain specialties based on their reputation. So I think that's why you're seeing these multi-specialty groups succeed and capture that, because it's a way of tapping into that loyalty.
And the primary care has got to be pretty tough to roll up because it's been picked over quite a bit. And the guys that are left standing, you've got Dr. Pat here in town with North Atlanta Primary Care. He's probably got 20, 30 locations. I mean, I couldn't name number two.
Right, right.
So
I think what you're going to see, though, is you're going to see these start consolidating, and you're going to have regional groups. And
even the
primary care, regional groups, and then regional groups become super regional groups. You're already seeing it in some areas in the Midwest.
Let's see. It looks like we've got another one here. Can you talk to any examples for financing large and growing outpatient groups where the PropCo and the MSO are financed separately? See many REITs and commercial real estate groups that will invest in PropCo and PE healthcare strategics that like to hold equity in the MSO. Yes, that's my question. Yeah, I mean, I think that we're seeing some of the more sophisticated groups that have taken this EBITDA and cap rate arbitrage to its logical conclusion. The problem that, or the thing that stops most groups from getting there is, a lot of debt. And, I showed up $3 million. Well, there's an opportunity cost for that $3 million that has to, come from somewhere, and whether that's capital or debt, but I mean, there's no one's unlimited. I think also it doesn't always work in every market. And so there has to be some flexibility, but I will tell you, one of the most advanced groups that I've seen is using the propco, the property company equity as a carrot to bring in the physicians, saying, hey, we're going to throw this out and you're going to own $10,000 in 60 buildings all around the country, all backed by a thing. Now, the physicians may have discounted that they're kind of double risked there, but they're able to trade out of those on a fairly regular basis, and we're seeing them come out at strong multiples too.
Right, and I see that when real estate folks come into the room or after, the physicians are very interested in ways to participate.
That's right. That's right. Yeah, there definitely feels like a kind of a golden something at the end of the rainbow.
Right. That second bite of the apple in a way sometimes for them.
I think also there's a little bit of just like personal jealousy that, because there's going to be some doctor that's like, oh yeah, we made $2 million on that, or we're killing it in the real estate, and that stings a little bit in the cocktail party. Let's see. What makes a deal over 20x?
So can deals be over 20x at all? So yes, there's really two or three reasons that a deal would be that high.
And you're talking about an exit multiple on EBITDA.
Right, on EBITDA. So the most obvious one is that the company actually wasn't doing too well, in that their EBITDA was small, but the asset base justified a certain price. And so then when you actually calculate it out, that price that you're paying for the assets makes the multiple artificially look high. Of course, we all know about DuPage Medical in Chicago, that deal. Part of that is based on maybe when you run a DCF and you put in expected payer increases of that percentage, well, then that's legitimate. You put that in your DCF, and so then it kicks out a number that maybe looks higher than trailing EBITDA. But, for example, look at Amazon, 79x trailing EBITDA right now, 50x forward EBITDA as of yesterday.
Yeah.
So these, what you're doing is you're looking at a significant growth. And in some areas, especially some metropolitan areas that are experiencing significant growth, and if you can consolidate these markets and do better, that would be what would put you at a high multiple.
We both represent a lot of hospitals, and I know that hospitals have been kind of active in this space, buying up practices to kind of control that value chain. What would a tip be for private capital that knows that a hospital's in the bid?
In the space?
Well, no, that they're potentially bidding on the same.
That they're bidding against there?
Yeah.
So, don't forget to sell culture and a strategy to win. So one of the things that
let me pause. So assuming that the hospital and the physician have the same culture is a mistake.
That's right. That is a mistake.
Yeah.
Because they typically won't have that. And so if you can sell a culture that's going to work with those physicians in a way that lets them maintain the things that they want to maintain, and present a culture that allows them to participate in the decision making for growth, and show that strategic plan, show them that you would bring in consultants to help them make their surgery center more efficient and more effective, and therefore more profitable. Show them that you'd bring in help in the management team to make all of those things, to normalize those expenses down. And if you can have them keep some equity, that's the best thing, because then everybody's got skin in the game.
Yeah. Let's see. What is the average multiple range for dental practices in the current market?
Oh man.
I knew you were going to get a question.
That's a good one. Yeah. I'd have to look at the most recent.
I won't put you on the hot seat.
Averages.
I've got an idea on this. I do know that individual dental practices are selling as a multiple on revenue.
That's right. That's very common.
It's not an EBITDA, and call it 1 to 3. And we can definitely put you in touch with people that are going to know this like tighter than not we are, because the exit multiples is not really my space. But I've heard kind of 70% of revenue to 100 is kind of in the range. Right. They're also looking for
0.7 would be a little bit distressed organization to go that low.
I don't know. I don't know about that. I mean, I think that anyway. They're also looking for physician leadership.
Right.
And so if you've got a dentist that shows he's got a business, then they might stretch a little bit have to stretch a little bit for that. I think that the exits that the bigger money is looking for kind of is 7, 8, 9, 10. Yeah. And depending on if you can get massive, you can get bigger. You can get toward the bigger end of that, because it feels more like a bond. I mean, this is your real estate broker talking. It feels more like a bond at that point rather than an operating business.
Right. And it's because of that, especially in dental, getting paid to get bigger. So then you have to buy more on revenue, because you may have a practice that the value of that is worth more than the EBITDA that they're bringing in an accretive manner.
And I think that also your debt can get cheaper. You get into kind of another stratosphere of sophistication for
you can reduce risk,
what they're using.
Right.
Let's see. What is the best vector for future growth, organic or inorganic?
Best vector for future growth, organic or inorganic. So I assume this question means, would you grow organically, meaning like marketing or new service lines or new procedures? And then inorganically, I assume that would mean more like mergers, acquisitions, licensing in some cases, even putting your brand name out and allowing, almost a franchise kind of a way like you might do in dental. So, that's going to depend on the market, whether you are going to look at organic growth, marketing, new lines. That's a longer lead time. In a lot of ways, it's the buy versus make versus buy proposition. Certainly right now, the fastest path to growth is that inorganic path through acquisitions. You're not seeing as much licensing going on in healthcare, but I think you're going to start seeing that as people get larger.
Interesting, yeah. I mean, some of the main big brands you definitely see a license on, but so I would say that I'm seeing a lot of the smaller. We've had a lot of conversation about dental, so a lot of the smaller dental groups are having to grow organically because they really can't compete on the sales stuff as much. Once they get to that kind of middle space, most of the dental groups are growing through acquisitions.
That's right.
And we represent probably 4 major DSOs, and none of them are doing new offices unless there's a fundamental kind of flaw with that office. At the same time, there are, and I can name 3 or 4 big dental DSOs who are only growing through acquisitions, and some of that's a real estate strategy. I think Aspen Dental is doing that a little bit.
And a lot of the multi-specialty practices today, same thing. It's more through acquisition, or maybe it's that organic growth of investing in your strategy and your facilities or in your equipment, and then therefore attracting over some of the physicians that are going to bring patients with them, have them join a group that they see as a better vehicle or a better fit for them. And so maybe, it might not even be by a whole practice, but you're seeing a lot of liquidity there, of movement of physicians. So then is that inorganic? It probably still is.
Yeah. Do you see, so this will probably be our last question because we won't have time just to wrap up quickly. Do you see cost structure evolution in healthcare?
So cost structure, well, as in maybe comps and assets, and
I'm thinking more just overhead operating expenses.
Oh, yeah.
This is an audience question. So, I mean, I would say we have to, right?
Yeah, well, then that's what you're seeing happen. You're seeing technology bring this about. You're seeing management teams. You're seeing practices that traditionally were maybe managed as a mom and pop, meaning maybe a family member was the practice manager. You're seeing them bring in professional management teams. You're seeing them bring in consultants to help them drive growth, to help them negotiate contracts, to improve their supply chain. You've seen some large players like Amazon and Warren Buffett, Bill Gates jump in, and I think that when they figure out that healthcare is different, because there's not another industry like healthcare where you don't go to a
Maybe
restaurant.
government.
Right. But you don't go to a restaurant and eat your food and then fill out a form and someone else decides whether or not what you had to eat was okay for you.
That's right.
Was it going to be
and declines to pay.
And decline to pay, and then you got to fight them for that. So you're seeing things like technology where people can, on their phone, if I can talk to a physician on my phone at 11 o'clock on a Sunday night, and they can tell me if I need to come to the ED or not, and they can prescribe a medication right there. The transaction of that cost goes down, and consumers are wanting it. So that's kind of the perfect storm that's going to force this, the transparency of pricing that's starting to happen.
Yeah,
is going to bring prices down, and I think the attention that's being paid into the management teams is going to bring prices down.
and I think that question about do you see a cost structure evolution in healthcare ties into the question that I wanted to ask to kind of wrap up this session, which is, what is cold fusion in healthcare? And cold fusion essentially is clean, portable, inexpensive energy. It's a theory that within a briefcase you could have all of the energy you consume in your entire lifetime.
Right.
And so it changes everything if we could get that. So what is the thing that changes everything in healthcare?
I think you should answer that question.
I have a good answer.
Do you? Oh, okay.
I mean, I think the group that figures out, and that's why it reflects on this cost structure evolution in healthcare. The group that figures out how to profitably deliver care at the Medicare rate is the group that wins.
Yeah.
And that's not just a good idea. That's a bigger than Apple idea.
Right. But it will drive, I think you're on the right track, and I think that's going to drive a lot of margin improvements, and the ones who are even heading in that direction with some of their operating companies and being able to deliver that care at a cost. Doesn't necessarily mean that that's where your pricing is going to be. That's going to trail, but that's what we call margin. And if you can do that reliably, because customers and patients want to have a relationship with someone that they can count on, that they can trust.
So if there are providers on this, they're laughing now because I'm saying we have to deliver profitably at the Medicare rate, reimbursement rate, and you're saying, hey, we need a relationship.
That's right.
And so, but there has to be something that comes together between that, and it's efficiency of payments, it's kind of removal of risk, it's inexpensive capital, or kind of a full understanding of the capital risk that goes into it.
Maybe we could get Medicare rates to come up a little bit too.
That could help.
That would help.
That could help. All right, so I promised, let me see, that we would talk about a couple of different options to kind of stay involved in the conversation with what we were discussing. September 5th, Will and I, along with 3 other groups, SunTrust, Robinson Humphrey, Wethington Law Group, and Waystar, we've got a suite on the field at the Braves game, and we're gonna bring the money and the physicians onto it. You see these kind of crazy posters behind us. Paloma put Cracker Jacks and peanuts, so we've got the peanuts and the Cracker Jacks in this room. And then 2, I showed you some of the data that we put together. We had to move through it quickly because we had a lot to talk about, but if anybody would like to get access to that, we'll give you password credentials. Probably need to do a quick call before just to kind of tell you how to navigate it, but happy to share that with you for a short period of time, because we build those custom for each engagement as we're kind of rolling through. And then Will's also got a white paper that is process-driven due diligence for healthcare organizations. And I think that it was obviously important. I think it was the #1 on the poll. And so having some of Will's early notes on that, and then having that, if you'll reach out directly to him, we'd be happy to do it.
Well, hope you guys got a lot out of this today. 5 tips and maybe a couple of nuggets that you can use to improve your operating companies.
And we gave you 10 minutes back.
How about that? You always want a little extra time back.
That's right.
Okay, see everybody September 5th.
Thank you.